right, Alan. Tell us about this shit that's happening in Wall Street or whatever right now.
So just to catch everyone up, last week on Friday, a bank by the name of Silicon Valley Bank went under and was taken over by the FDIC, the United States federal government, because it was insolvent, which means it wasn't insolvent, it was illiquid. It had money, but it wasn't in any form that it could deliver as cash, so there was a run on the bank, and they failed. Subsequently, another bank on Sunday failed as well, Signature Bank, and I wanted to talk a bit about how that happened.
All right, well, let's get into it. Where do we begin? Lay it out for the layman and tell us how we arrived in this situation.
So just to understand how we got here in the first place, back in 2020, when COVID hit, the United States federal government started pumping a lot of money into the markets to keep them afloat. They had been on shaky ground for a while for a bunch of reasons we don't have to go into here. But as a result of that, all of these banks had a huge amount of funds to play with. To contextualize this, in the case of Silicon Valley Bank, they went from about $21 billion in assets to $120 billion in assets in 1 year. And so they had a whole bunch of money just sitting around. And these are capitalists, so they're not going to just leave it there. So they decide to invest it in quote unquote safe assets. And these are going to be primarily government-backed mortgage-backed securities and United States Treasury bonds, which at the time had about a 1% return.
And considered safe.
Yeah, like it's government-backed money, and basically the way it works is you give $100 to the government, and they say, okay, sweet, in this amount of time, we'll give you back $100 plus a percent. So in the case of Silicon Valley Bank, they bought like 10-year bonds at 1%, so if they spend $100, they'd get $110 back, or $101 back after 10 years. But the problem was, 2 years later, we arrive at last week. A whole bunch of people decide they want to pull their money out, but they put all those money in those bonds because, for whatever reason, these bankers decided that they weren't a commercial bank, they were an investment bank, and they were going to put all of their clients' money into illiquid assets, which is, I'm pretty sure, actually illegal, or against the rules anyway. So if you go to an investment bank, you're giving the money to the bank with the explicit intent for them to put it back into the market to generate a return for you. With a commercial bank, you just want them to hold on to your money because you need to put it somewhere. It has to be what they call high-quality liquid assets. So these are things that are not risky and can be easily converted back into cash in the event that someone wants to withdraw their money.
Yeah, that's the expectation is there that it's always available.
Yeah, exactly. So they put too much of their eggs into this basket, which would have been fine in an environment with low interest rates like it was at the time, but interest rates are just going up right now, and that was causing those bonds, as well as the mortgage-backed securities, to go down in value. So they had a whole bunch of unrealized losses on their balance sheet. I think it was something like $168 billion of unrealized losses.
God.
And on last Wednesday, in order to shore up their liquidity, because they've been having a lot of people pulling out money recently due to the higher interest rates, they sold $21 billion in their holdings, and that ended up in a $1.8 billion realized loss. A man by the name of Peter Thiel, I'm calling this guy out specifically here, because this is, to be clear, this man's fault entirely.
We're coming for you, Peter.
He's the head of a venture capital fund called Founders Fund. He called up his startups and he told them, pull your money. They just realized a bunch of losses. They're not solvent. We need to get their money out of there. And so that started a run on the bank.
It sort of ignites like this race to try and pull out the money out before you get fucked, right? Before the bank runs out and they have nothing to give.
Exactly. You don't need to know what's going on. Just you see other people pulling your money out and you know, okay, well, I want my money out before they're out of money. And that causes the bank to go under. The exact same thing happened to Signature Bank, which went down on Sunday. So instead of being for venture capitalists, I think this was a crypto-centric bank. It wasn't because of crypto. The same issue with Silicon Valley Bank happened. It was a classic run on the bank. People were spooked by the events of Silicon Valley Bank. And it does look like it's spreading further. So in response to this, the Fed and the Treasury went out on Sunday and announced that they were going to fully back all depositors. They were going to be using a fund that banks pay into in the FDIC, which contains about like $120 billion in reserves. to pay out depositors and make sure that everyone is kept whole. Basically, they are betting on these two banks being the first and only to fall. They're going to stop the contagion here, because if $120 billion is not enough money to save the economy, if this ends up becoming a domino effect.
And how badly does that affect inflation if it does stop here?
I imagine if this is the end of it, if they just end up backing up the losses from these two banks, which aren't like incredible, probably not significant. I do, however, suspect that that's not going to be the case. And the reason I say that is because other banks are struggling pretty hard. There's a bank called First Republic Bank that was down something like 60% on Monday. I haven't been watching it today, so I don't know what it's at today. There's also Charles Schwab went down like 30%. Banks across the entire nation, regional banks, none of the really big massive banks, were like double-digit losses, getting halted because of volatility. And then even the big banks were all down. And so I wouldn't be surprised if people see that and then get scared to start pulling money out of other unconnected regional banks and triggering this sort of domino effect.
If it does continue, like let's say 20 more smaller banks fail, like not the big ones obviously, but like if the smaller ones do fail, then do you think the Fed will continue to print money to keep them afloat?
So they didn't say there was a cap on how much money they were going to put into the system as part of this program. They didn't say they were going to start printing money, but they're going to. If they run out $120 billion, they're not going to have a choice. So what the system actually is banks can offer up, they're calling them, I think they're called high quality assets is the term they used. These are going to be things like government bonds and mortgage-backed securities as collateral for loans. But the kicker is that they're going to be accepting them as collateral on their par value instead of the market value. So what that means is instead of you getting an amount of money equal to the value, the current market value of the assets you give up as collateral, you get the amount that you paid for when you first bought that asset. So even though it's gone down in price, you're still getting the whole amount. So what this means is that a bank can take this $100 treasury bond that they bought back in 2021 that's worth like $60 now because of the interest rate increase. Give it to the Fed, get $100 back, go buy a current U.S. Treasury bond for $100, which returns 6%, essentially just giving the money back to the U.S. government. Yeah. And then they can turn around and sell that Treasury bond on the open market to get the money from the bond like right away.
Yeah.
So they turn that $60 Treasury bond into $100 cash into like $110 cash, which they can then go turn around and buy a $100 Treasury bond and there's $10 left. It's the infinite money glitch.
It's the infinite money glitch, man. They're doing Grand Theft Auto 5 hacks. how do I get it on this cheat? What's the code input?
Be a bank.
Oh shit! All right.
So the good news from this, right, is that the Fed is absolutely correct in saying that this is going to stop a domino effect, in my opinion, of banking through the market, because this did turn on the infinite money hose. The reality is, depending on how bad this situation gets, inflation could get very, very bad.
Yeah.
And it was already like a struggle to keep it down.
I think everyone's feeling the squeeze of it at the moment.
Yeah, like the current crisis was caused directly by the interest rate hikes. So it's like we can't keep... So we're going to keep on raising the interest rates. That's the plan. But at the same time, we're going to be printing money and putting it into the market.
I mean, obviously, the banks will always do what's advantageous for them.
Yeah.
Do you think any banks will do this in a way that will push things in a negative direction, for their own profit?
I think it's almost guaranteed that someone's going to do that. It's just sort of like these banks, I almost think of them as forces of nature, and they're just like maximizing profit through whatever regulatory tools are available to them, and sometimes outside of those tools too. So if they are given a way to create infinite money, I would expect them to be frank.
It seems like putting them in a position where they're able to take advantage of something, like why the fuck wouldn't they?
Yeah, and with inflation already being at what it is, we're going to have to keep raising interest rates. And inflation is going to get worse from this. Probably not for a while. There's usually a lag of, I think it's like 18 months between when money gets printed and given to the finance market before we start feeling it on Main Street.
Right.
But I would expect, my feeling is that things are going to calm down. in the short term, but get really bad in the long term.
Right.
But I could be wrong. Like, the banks are in turmoil right now. I saw that today, like, JP Morgan and Chase just put up like a share offering to shore up liquidity, which is the same thing that SVB did that triggered a bank run on Wednesday. So it's looking bad, because JP Morgan Chase is the biggest bank in America, I'm pretty sure.
Right.
And then there's also Credit Suisse, which is not even an American bank. That's a Swiss bank. They're credit default swaps, which is like a derivative that you can use to get insurance against a company that you have loaned money to in case they go default, you still get money back.
And they're defaulting.
Well, so the price for those credit default swaps is skyrocketing, which means people are buying them because people are expecting a default.
Oh, okay, I see.
Yeah, and their stock has been suffering, and they recently said they had to delay their quarterly like report because they were requested to by the SEC. And the important thing about Credit Suisse is it's not an American bank, so they don't have access to the infinite money printer. And also, it's a globally systemically important bank, which means that it's got enough fingers and enough pies that if it were to go down, it would take the system down with it.
I see. So I guess the question I have to round off everything, Alan of the finances, Alan Finance. Here's my question for you: what should Joe Blow, i.e., me, what should we do? Future being uncertain and possibly very scary.
Well, my advice, personally, I wouldn't necessarily say go get your money out of the bank right now, especially if you're not in America, because at the moment things are just, there might not be a whole bank run yet. So just like pay attention, listen to your local representative if they give you any advice on the matter, and buy non-perishables.
And don't forget to subscribe to the channel for more info coming soon.
Yeah, subscribe, guys.
We'll let you know when things get real bad.
We'll probably do another one of these with an update if things get spicy.
Yep.
So, I'll hopefully next time you hear from us, the economy still exists.
The economy. Amazing.